Good morning, good afternoon, good evening. It's great to have you with us, wherever you are in the world. I'm looking out, seeing where I see audience members from. There, I see some folks from Japan. I see China. There's Indonesia. It's warm there in Indonesia. And I see some very early risers in India. I see some night owls in Mexico. And wow, the list is too long. I'm not going to go on, but you get the idea. We've got people from all over the world joining us, and we really appreciate that. My name is Jim Sutter, and I'm the CEO of the U.S. Soybean Export Council, and it's great to be here with you. I get to be your host this evening. Thank you for joining us for this WASDE Recap for the month of May. This is an exciting month, as it's the first time we get the balance sheet for the new crop, and it integrates the planting data for March, which forecast, by the way, a record planting number. You'll hear more about that. The world, as we look out at it, we see no shortages of challenges right now. And you probably all know that better than I do. As I look around at what's impacting global food and agribusiness, we have many things. The unfortunate situation in Ukraine, the global demand ramp up post-COVID, supply chain issues and shortages of some important raw materials, volatile and falling or active economic and stock markets. All of this leads to a great deal of uncertainty. But there's a couple of things I want to mention that are not really uncertain. I want to remind you, the customers of U.S. soy around the world and all of the other stakeholders around the world, the reliability of U.S. soy and U.S. agriculture has been there for a long time. And as you make your business partnering and soy sourcing strategy, think about that. Think about the reliability of the U.S. infrastructure and our U.S. farmers. And so I'm mentioning our farmers. Year after year, our 500,000 U.S. soybean farmers, most of them family farmers, all the way through our export supply chain, they work to make sure that we have a stable and reliable supply to meet the needs of our customers around the world. So let me tell you about what we're going to do today. In just a minute, I am going to welcome Mack Marshall to the screen. He serves as the Vice President of Market Intelligence for USB and USEC, and he's going to share a few quick highlights of the report. Then Mack is going to be joined by a familiar face and someone whose expertise and perspective we greatly value, Chief Commodities Economist for the StoneX Group, Arlen Suderman. They're going to explore findings from the report, and then eventually we'll get into your questions, which reminds me, don't forget to enter your questions in the chat box throughout the session. So whenever you think of one, please enter it. We will have a special guest tonight, Mr. Shang Xiaoping, who is our Regional Director for Greater China, will give us an update on that region of the world. I think everybody's interested in what's going on these days in China. So remember to enter your questions, and let's get on with the program. We've got a lot to talk about, and we've got great speakers. Mack, I'm going to turn the floor over to you right now.
Fantastic, and thank you very much, Jim. Now, let's get right into today's report. Now, of course, it's always exciting to see the initial look at the new crop balance sheets, but first, let's start with revisions to the old crop for marketing year 21-22, those balance sheets. So first off, world ending stocks were revised down by 4.34 million metric tons to 85.2 million metric tons. This would be the smallest absolute stocks figure since the 15-16 marketing. There were no cuts to Brazilian or Paraguayan soybean production, but USDA did issue a 1.5 billion metric ton reduction to Argentina, which drops Argentine production to 42 million metric tons. After several cuts this year, China's crush was maintained at 89 million metric tons. Now, for the US, the strength that we've seen in the export pace translated into an upward revision to the export projection of 25 million bushels. So that changes about 700,000 metric tons. Now, with that increase in the export projection, ending stocks were taken down by a similar 25 million bushel count, dropping projected carryout to 235 million bushels. For meal, the 200 million short tons were shifted from export to domestic use. For oil, there were no old crop volume changes, but the price projection was taken up by 5 cents to 75 cents per pound. Let's look at South America for a minute. Now, I've shown this slide for the last couple months as we've seen large revisions to South American soybean production. Now, as mentioned earlier, for May, we only had to cut the Argentine production, but with that cut, total production across Brazil, Paraguay, and Argentina is now out over 32 million tons, lower than the expectations in December. So quite sizable. Basically, in US terms, that'd be about a quarter of our crop. Now, those are the highlights for the old crop balance sheets. Now let's turn to the new crop balance sheets. For the US, now based on that record expected plantings figure of 91 million acres and trend yield of 51.5 bushels per acre, USDA is projecting a record crop of 4.64 billion bushels, or about 126 million metric tons. Now, this is not surprising, as it's custom for USDA's May release to use the prospective plantings number for acreage and trend yield for yield. This didn't necessarily hold for corn, but we'll get back to that later in the program. Now, with the growth in production, we are expected to see some inventory build and take that up to 310 million bushels, or 8.4 million metric tons, over the balance of the new crop marketing year. USDA is also projecting prices to be strong this year, and the new crop futures curve supports this projection. With here we're seeing the marketing year average price forecast of $14.40 a bushel. Actually, right before the program, Jim, Arlen, and I were talking, and that is the highest marketing year average price that was put out in the WASDE since the 2012-2013 marketing year, which of course was a drought year in the US. Now, on the demand side, both crush and exports are projected to increase relative to the prior season. The estimated crush figure of 2.255 billion bushels, or just over 61 million tons, would be a record. We're starting to see the impacts of the expanding crush throughout the US, that new capacity being reconciled in the balance sheets. So for the co-products, USDA is projecting some price relief for both soybean meal and soybean oil as that crush increases. Exports of meal are expected to increase slightly, while oil exports decrease. Now, for the soybean oil biofuels use category, USDA is showing a year-on-year increase of 1.3 billion pounds. Now, on the surface, this does look like a lot, but it's important to recall that at this point last year, USDA's initial projection for soybean oil use in biofuels was also 12 billion pounds, but was subsequently revised down several times to the standing figure of 10.7 billion pounds. Now, let's turn to the global projections for production, consumption, and exports of whole soybeans. World soybean production is projected to rebound to 395 billion tons, roughly a 45 million ton increase from the current marketing year. Now, nearly 39 million tons of that increase is concentrated in South America, as projection is expected to rebound from a drought year, and area continues to expand in Brazil. Now, with higher overall production, global ending stocks are expected to grow by over 14 million tons this upcoming marketing year. Now, on the consumption side, world demand is projected to be a robust 377 million metric tons, so more than 1 million tons a day still, up over 14 million tons from the prior season. Now, crush is projected to be up about 9 million tons across the 4 largest crushers in China, the United States, Brazil, and Argentina. Now, lastly, with the expected rebound in production, soybean exports are expected to increase by over 14 million tons across the globe, with nearly all of that increase concentrated in the US, Brazil, Paraguay, and Argentina. The latter 3 countries, of course, all rebounding in production from last year, and the US expected to have record production this year on the heels of a record crop last year. So this concludes my quick comments recapping this morning's report. It is now my esteemed pleasure to welcome back to the program Arlen Suderman, Chief Commodities Economist at Celnex. Arlen, welcome back. How are you?
Doing well, Mac. It's great to be back with you again.
Well, no, it's always a pleasure to have you. Let's jump into it. New crop, old crop. I don't know where you want to start, but what jumped out to you from today's report?
USDA did kind of what we expected, continuing to raise U.S. soybean exports in the old crop. And I expect that to continue when you look at the price relationship we've seen with the smaller crop in South America. We expect to see a strong contra-seasonal export season this summer in the 4th quarter of the marketing year. Start stepping up as we get into June, and even more in July, and then even stronger in August. And so if we're going to hit USDA's current target, we need to ship about 21.1 million bushels per week. For the last 3 months, my export target has been 2.225 billion. In order to hit that, we need to do about 25.5 million bushels per week. I think that's attainable. My crush number is a little bit lower. I think we're on target for a little bit lower crush number. And then I'm more aggressive in the new marketing year at about 2.28 billion bushels as we continue to expand demand for crush and the capacity for crush. So I think the big difference that I see is with USDA, as I look at the 22-23 marketing year, we both are very aggressive in expanding South American production next year. USDA is a little bit more aggressive with US exports. I hope that is true, but typically Brazil, Paraguay empty out before we get the business, so to speak. From China anyway. China prefers that a lot of times. And so my export target is below USDA, and I end up with a healthier level of stocks for the 22-23 marketing year in the upper 400s. So I think if weather is good, we have a normal expansion, a typical expansion, I should say, in Brazil this next growing season, and weather is good this summer. Soybeans are the one commodity that have the chance to grow their way out of short supplies and be adequately abundant for our customers in the year ahead.
It's a great point to draw out because, you know, as Jim said in his opening remarks, we pride ourselves on being a reliable supplier to the world. And, you know, certainly with the disruptions that the world is facing right now, obviously acutely in the Black Sea, but, you know, beyond that, it's got ripple effects in terms of supply security globally. And, you know, I think as we're looking ahead to this season, you can't take any production for chance, right? Sure. So, you know, looking ahead to you know, this marketing year, obviously, you know, planting has started in many parts of the U.S., but we're also, you know, behind in terms of planting pace. You know, can you help us reconcile that in terms of where we are versus, you know, the historical and you know, if there's anything that we should be watching for over the balance of this cropping season before you know, before we get to the actual selling season post harvest.
Yeah, it's been a slow start to the planting season, and you know, we're in the mid-teens this last week as far as planting progress. We should see active progress this week across central and eastern parts of the Midwest, and probably not as aggressive as we first thought a few days ago. It took a little bit longer to dry some of the soils out than what we thought. Even with the heat that came in, the soils were a little tighter and didn't seem to dry out as quick as we thought. Some areas are saying it took them an extra day to dry than what they thought. Some areas saying an extra 2 days, but I think we'll be pretty aggressive and really come close to closing the gap. But then the rains start to come back, and with the conditions we have, those soils will get wet much quicker now. And we're not going to have the heat next week with more showers around. So I think progress is going to slow again. So I think we're going to overall plant the crop late, but it's going to get planted. The exception is going to be in the northern plains, northwestern Midwest, where the next 10 days continue to be wet. And so I think that actually favors the oil seeds, favors soybeans. I think that'll be an alternative crop, the shorter season soybeans going in there. We'll probably lose some more corn acres there. We'll probably lose some spring wheat acres, probably plant some more sunflowers, but some more soybeans as well. And so I see greater odds that our soybean acreage is going to go up from the March 31 numbers. Corn will go down.
It's interesting. You know, certainly a prevalent question across a lot of analysts since we had that March 31st report is, you know, you very high on beans, very low on corn. You know, typically when you think about planting on the margins and some of those last mile or last minute decisions that farmers are making as far as the crop plan, you know, in a typical year, you know, you'd probably see it more of a swing back to corn, but it's really interesting. You overlay the fertilizer shortages, you know, that we have, which certainly factor into that, you know, structurally reduced corn number for this year. And then you look at the wet spring, which is, you know, pushes things back towards, you know, more likely to skew towards soy in many parts. And it's just a lot of interesting dynamics at play this spring. But if I'm hearing the key takeaways, Said even though we're off to a slow start, I don't think it can be overstated, how quickly catch up can happen here in the U.S. And once you get a couple great days, you start seeing those planters moving around and getting seed in the ground. So, I think our farmers are, well positioned to get us off to a good start here. I want to go back to some of the comments you're making earlier around export pace and how you're kind of reconciling your balance sheet, looking at what we need to ship on a weekly basis to hit the USDA targets or even hit higher targets there.
Mhm.
It's we've had this really strong counter seasonal pace, and Jim has mentioned this many times. I think over the course of this particular year, we're seeing a lot of counter seasonal strength in U.S. soy shipments, and I certainly think that's really something that is exciting to see. One, you get to balance out the pace of shipments over the course of the whole year, which of course means that buyers who might not ordinarily be looking for the U.S. in the latter half of the marketing year are seeing that opportunity. So we're certainly very, very excited about that. But I think there's also responsibility behind it as well, where those global shortages and backfill and everything is really, really critical. So with that, I kind of want to pivot over and talk about I think what's on everybody's mind here, and maybe it's a little bit of a shift away from beans for the moment. But Black Sea, obviously there were some notable revisions on the grains and some of the soft seeds as well. What's your take on some of the cuts that have been implemented, particularly for Ukraine? Because I actually saw some of the production figures go up for parts of Russia. So maybe we'll center on Ukraine here in the grain and soft seed complex.
Yeah, it's a very sad situation in Ukraine and what's going on there, particularly for agriculture, as we're seeing agricultural infrastructure specifically being targeted, equipment being either destroyed or taken, grain, same thing, elevator facilities, infrastructure, bridges, rail lines, etc. They've done a fantastic job of keeping the rail open. And I believe I saw one report that from all the attacks on the rail, no rail line's been down for more than an hour, as they've been able to very quickly get repairs in place so far. And so they're moving grain as quickly as they can across the western border. Last month, they were able to get over 1 million metric tons across the western border. That's less than 20% of what they were exporting through the ports before, but it's making improvement. That's probably going to go down as we get later in the spring and we see other Eastern European countries focus those rail lines on moving their wheat harvest, their harvest of spring crops, but they're making progress there, try to do that. They've got about 75% of the expected acreage planted of their spring crops, focusing more on some of the cereals that can be used as food, lower levels of resources required. If you look at the corn area that's been planted and expected to be planted, right now it looks like it's going to be down by about a third. Production, I thought USDA's numbers today were pretty good, looking at about half a crop, a little less than half a crop, because as we talk to our customers there, we're hearing reports of fuel shortages, fertilizer shortages, chemical shortages, so yields will probably hurt. And then it comes down to, if they're able to produce it, will they be able to export it? They'll continue to try to develop those channels over land. That's never going to replace what they can do by port. If the war would end today, I think the optimistic outlook is that it'd be 6 months before they could do any measurable exports through the ports. Russia has stated their goal is to get control of the ports. They've really had trouble doing that, have not been able to for the 2 major ports, but that is a goal. It's a high goal of theirs to be able to shut off Ukraine's ability to do commerce via those ports. And so I think we're going to see Ukraine continue to try to build out their rail. One of the problems with rail is their rails are the old Russian style, 10 centimeters wider than the European gauge. So every rail car has to be manually jacked up with a new carriage put under it, or unloaded and reloaded on the Polish or Romanian cars. And so they've got a backup of cars, thousands of cars backed up at the border, trying to get them through, basically looking at 19 to 25 day waiting periods once they get to the border, move on, but they are making progress.
Those rail comments are really just kind of astounding to behold, just to think about just that changeover in gauges and width, and that can be, that's an impediment towards grain flow, absent of war and everything, and really I think just we keep coming back to that reliability of supply, and part of that is really incumbent upon the infrastructure that we have and the continued investment. In the U.S., I think it's easy to take for granted, but we definitely, having a strong infrastructure system is really critical. One other, and that rail thing, just, one thing I noticed in the oilseed circular that USDA put out later is they actually took up the Ukraine projected exports of sunflower seed, pre-crush on the strength of overland transportation. So, it's nice to see, I think, even, some bright spot come out of that region as far as balance sheets are concerned here. Since we have Xiaoping coming on in a couple minutes, or from China, I want to bridge it a little bit. What'd you make of the China crush numbers that were there for old crop, and then the figure for new crop? We certainly see those coming down a lot, and the crush margins have been pretty weak in China as the hog recovery continues, but the hog prices are pretty low, and it's kind of backing up into the system. What are you seeing potentially in terms of rebound that can speak to that growth in that crush number for next season?
Yeah, I'm a little bit more optimistic than USDA. I think their numbers are pulled down a little bit too much, and some of the Chinese numbers, I'll back that up. They do get a little bit more aggressive for the next year, and I would tend to agree with that. And I think we're overall pretty close. Ever since the August 2018, when African swine fever was first found, and we saw so much liquidation in the hog herd and pork prices in China soared, we saw a shift in consumer demand kind of away from pork. It's still a favorite meat in China, but when it's starting to try to get the demand back, then the COVID lockdowns come in. So it's been a tough time for the industry. They're trying to rebound and come back. The margins, if you look to the pork to corn price ratio, it's still below levels that they'd like to see it, but the margins are starting to improve. So there is some hope that in the last half of this year, particularly if we can get COVID under control, that we can see some better margins there, maybe see some of that feed demand come back. I also look for China. China has a reputation of stockpiling supplies when they're able to. And I look for them to be a little bit more aggressive on importing soybeans to do that, but more so corn. And I think USDA, they went along with the China line on corn imports at 18 million metric tons. And I think that China is going to be more aggressive because they had used their reserves down. They want to rebuild those because I believe, talking to our contacts there and just reading the tea leaves, so to speak, that they're worried about short corn supplies in the world. And I think that's also spilling over soybeans too. And they want to make sure they get their share of the supplies before others do, and are going to buy it even if they don't need it to put it in storage.
It's a great point there. I mean, I think when you look at the cuts for Ukraine, I mean, it's taking what, roughly 14 million tons of exported corn off of the market there, if you're going off of the balance sheets from today. Yeah, so we'll come back in a couple minutes to take audience questions. Very excited for that. But for now, let me pass it back to Jim. Jim, please take it away.
Wow, thank you, Mac. Thank you, Arlen. What great insights and information. So remember, folks, if that spurred a question, put it in the chat, because they'll be back in just a few minutes for our Q&A session. But right now, help me welcome Mr. Shang Xiaoping, who has been collaborating with the U.S. soy industry and customers in China and stakeholders, both here in the U.S. and other markets, for over 20 years, and has been our regional director there for the last 10 years. During this time, he's accumulated a wealth of knowledge about how things work in China, about the livestock, aquaculture, trade policy issues. And Xiaoping is here with us this evening to just give us a little bit of an overview, We could obviously have a whole session just on China, and you just heard some interesting things. But Xiaoping is just going to give us a brief overview on what's going on in his region that he thinks the people who are tuned in for this WASDE session would be interested in. Xiaoping, I'll turn it over to you. Thank you.
Thank you, Jim, for your introduction. And I feel much privileged for China to be in the spotlight at this WASDE webinar today. Thanks for the opportunity. My pleasure to share some of my thoughts on what's going on in China. You know, people in the market and in the trade have been following WASDE report very closely, especially on China numbers, because of its the volume and the impact on global market in terms of imports, crushings, and total domestic production, consumption. You must have noticed that these projections from USDA, including soy meal consumption for current marketing year 21-22, have been adjusted lower almost each month since last November. And today's number, you know, for imports is adjusted 1 million metric tons on top of last revision last month. It's now 92 million metric tons, 89 for crush, almost 70 million metric tons for soybean meal consumption, and 108.72 million metric tons for total domestic soy consumption. And those are 9 to 11% reduction from its initial projections a year ago. So I personally agree with all these adjustments, although not the exact numbers. And I think the key factor behind is the swine production, swine situation in the country. You may know that about 40% of soybean meal are consumed by the hog farming industry here. Since early January 2021, hog margin started to slide from the historical highs made in 2019 because of African swine fever, and 2020, such as you know, as high as $400 to $500 per head. And in about 1 month, you know, hog farming changed, you know, from a lucrative business to money losing for producers of purchased piglets, and for those self-breeders, it was less than 6 months, you know, last year, to be in the negative area for their margin. Then hog farmers, large or small, have all been suffering from huge farming losses, being squeezed by the high input cost, corn and soybean meal, and also the falling pork prices during this period. And the biggest loss was seen as more than $200 per head, you know, last June. Improved for a very short while in last November and December, and then boom, heading back to, and also staying till now in the negative area since early January this year, with current loss of $4 to $40 per head, depending on how the farmers are getting their piglets. Things have been even worse with the telling effects of pork imports and also the sluggish demand due to the resurgence of COVID-19 in terms of Omicron variants in many cities in the first quarter of this year. Producers have to turn to less expensive feed ingredients to survive, and this has resulted in less demand for soybean meal, leaving poor margins for crushers here who slow down their soy input purchases. Some industry people are expecting that pork price might hit the bottom of the current hog farming cycle later this year, as indicated by reduced hog inventory, including reproductive sows, while China is expected to gradually relax its restrictions starting in late May or early June on travels, on public gatherings like industry expos, entertainment, theme parks, etc. Food demand will soon come back in full swing, I think. Now, USDA today provides the initial projections for 22-23 soy supply and demand situation in China, with soy imports at 99 million metric tons, crush at 95 million, and total domestic consumption at 115 and 59 million metric tons. Those are very nice increases, like 7.6% for import, 6.7% for crush, and 6.3% increase for domestic consumption, respectively. So from the, that's the increase from the most current estimates for 21-22, which are not surprises to me at all, and probably for many others, like Alan just shared his perspective, as we can get a clue of the demand growth from several factors, such as the expected stepping off the bottoms in the peak farming cycle, expanded and also large poultry industry consuming soybean meal, and the reopening of the economies and economic activities in post-COVID area this year, later this year, and even if we might see a 1 to 1.5 percentage points drag anecdotally on the targeted annual GDP growth of 5.5% due to major lockdowns for a couple of months this spring. The size and the volume of the economic growth will still be enormous. These factors support a bullish outlook of China demand. And what I want to mention here is, 4 years in the past 12 years, that's 4 out of 12, May WASDE reports, China's soy imports and crush were overestimated only 4 times in the past 12 years. Well, for domestic consumption, it was overestimated for 3 years. So for 22-23, I incline to believe that the initial numbers are quite reasonable, and probably we might see some slight increases of these projections as we move along into the year to hopefully confirm an even stronger growth in soy demand for the upcoming year. So let's keep close watch on China, and that's the world's #1 importer, #1 crusher, and #1 consumer. So with that, I end my comments on China demand. Thank you. Turn it back to you, Jim.
Great, thank you very much, Xiaoping. And I'm going to turn it right over to Mack and Arlen, who are going to come back for the live Q&A. Please don't forget to put your questions in the chat. Thank you, Xiaoping.
Thanks.
Thank you very much, Jim, and thank you, Xiaoping. I think getting that perspective from from within the country, within the market. Clearly, there's a lot of disruption that's been unfolding over the last couple of years that we've experienced on a global basis, but a lot of that's been really acute in China. And considering that the market is still operating with those headwinds, and you're still poised for growth going forward, I think is incredibly encouraging. And we just need more and more good signs, coming out of various markets. So I really appreciate the update there. Having some questions come in, Arlen. We touched on the delay in planting earlier. People are wondering, what's the expectation of the impact on the harvest? Maybe let's start with soy first, and then I want to go over to corn for a minute, because I think there's some relevant stuff going on there.
Well, first of all, we look at with the corn crop, we're going to be pollinating a large portion of the corn crop all in a week or 10 days time, as we're planting such a large portion of it. And so you can look at soybean pollination is a little bit more spread out than what is corn at the flowering stage and pod fill. So corn's going to be most vulnerable. That's good if the weather's good when that happens in July. It's not so good if the weather's not good. And there's certainly some risks with that. Some higher risks this year that we're going to see high pressure set up over the Midwest. So that's a concern for corn. I think for soybeans, obviously it does tend to push it back a little bit, a little later harvest, although soybeans are more day length sensitive. here in the United States, more so than what we see the changes in Brazil. In Brazil, obviously, if you plant 2 weeks late, you're going to generally harvest 2 weeks late. In the United States, we tend to catch up and we don't change the harvest date quite so much. So I think we're going to be fine on the soybean harvest. It's going to come down like it always does, whether we have an early frost or not. At this point, it's too early to have any kind of indication on that. So we have to assume a normal harvest. So I don't see any problems right now with the quality or the quantity of soybeans from the late harvest. You still hope that you have a good summer to follow to give you the opportunity to develop a good plant, have plenty of blooms, plenty of pods that set and fill well. We'd like to have a long grain fill period in August, but you know, we hope that regardless of when we get planted. So I'm more optimistic on the yields of soybeans than I am on corn.
So actually, I follow you on Twitter, and I want to encourage all our viewers here to follow at ArlenFF101. And you pointed out something interesting about today's report for corn, right? USDA actually took down their corn yield from projected 181, which was basically trend yield, to 177 bushels per acre. What do you make of this? That seems like kind of an anomaly for that change to happen this early.
It really is. USDA tends to calculate its trend yield over the winter time, and they reveal it at their outlook forum in February. And that's what they pretty much stick with for the May report. They have occasionally, very rarely, if we're an extremely poor planting condition type of situation, have reduced it. So you say, well, this was a delayed year, but the very week that the report comes out was a big catch-up week as well. And even in 2019, when we had such a slow start, USDA waited till June before they lowered their yield estimate. I thought the 181 was too high in the first place. I've been served very well with a 30-year straight line trend yield, and that would suggest something closer to a 178 yield. And so that's what I was ready to go with. But then USDA came out the 181. And I thought, well, that's what they're going to use. And as you said earlier, they used the March 31 acreage. That we weren't expecting any surprises on the supply side of the equation. And then they do. The 177, I'll look at it from a different angle. When we get a late planted crop, our highest yields, our above trend yields, come from an early planted crop. And that's pretty much been ruled out now. And based on the weather forecast we have now, the bigger question is, can we reach 177? Because corn's going to be more sensitive to that. And so each week that we delay planting now, I think we see really good progress this week, maybe get corn planting up in that 56 to 60% range next week. Then I think it slows down again, and I expect it to get planted, but it's going to be later. So that makes 177 a challenge. 2019, we got the 167 yield because we had almost a perfect growing season with a late frost. Then the rest of the growing season really worked out well. How often do you get that perfect follow-up? And so we're going to have some challenges there on the corn side. Feel much better about the soybeans as far as getting them in and getting the yields. And we've got the incentive for farmers to really take care of those beans and get that production.
Oh yeah, I mean, with the price levels where they are now, granted that's mitigated, of course, with significantly higher input costs across the board. Fertilizer, crop protection, labor, fuel, everything. Farmers are certainly want to maximize what they're bringing off in the combines come fall. Let's jump ahead a little bit further in the value chain here. I got a question coming in. We'll provide an update on the renewable diesel program in the United States, and just with price levels for feedstocks, soy oil, and then crude oil, being certainly expensive right now too. Any potential impact to the development and progress of the renewable diesel industry build out in the U.S.?
Yeah, I'm encouraged by how it's moving forward. We are hearing more of the food versus fuel rhetoric come back up again. And if you recall, that was really big in 2008 when we had some weather problems and higher prices. bit slower to develop now, and I think it's a different environment than what it was back then. We are seeing more pressure to reduce the biofuels in Europe, but seem to be going strong here in the United States. Many of the mandates that are supporting the production of renewable diesel are state mandates, in addition to the federal mandates. The subsidies are pretty significant. We're seeing reports over the last week of a couple of different major producers of renewable diesel stating their commitment to move forward. They're continuing to open up the plants, and they're stating their profit margins are good. And a lot of that's because of the subsidies provided in those state mandates, but we're seeing that demand be there. I said earlier that my crush estimate was slightly below USDA for this year, but I have a much more aggressive crush target for next year, partially because the capacity is larger and partially because we're seeing these plants open up and the demand is going to be there. So I think by the time we get to 2023, 2024, 2025, that we're going to see demand for soy oil almost really exceed the supply of soy oil, providing a nice incentive to continue to produce those soybeans. And I think it's going to be a good time for the soybean industry. If we continue to see some shortages of wheat and other food products, some of that food for fuel debate could kind of come over onto the edible oil side as well. So that's a risk that we're going to have to monitor and be ready to address.
Two quick points I want to make in response before we turn back to Jim for closing remarks. One, I think it's important to recognize, the timing of when these builds are coming online. And I think some of the potential slack that we could see in terms of, supplies coming back in terms of the vegetable oil complex in the coming seasons. You look ahead at the futures curve, or you can look ahead at what USDA put out for the forward-looking price for next marketing year, and seeing some relief there. Obviously, it's still high relative to historical norms, but you think once we inevitably get past the production disruptions across the Black Sea, sunflower seed oil comes back, rebounds from this year. We're already seeing in Malaysia, where we've had production disruptions for palm for a couple of years through COVID, now starting to get labor back in and resume what would be more of a normal harvest. I think that'll be beneficial for palm oil supplies globally. Of course, you have short-term cuts from Indonesian exports because they're trying to keep domestic prices lower. But I think that you look ahead over the next 1 to 2 seasons, and as you have more supplies coming online in terms of vegetable oils and feedstocks, you can see some bit of a rebalancing there. And certainly futures curves look at that. The other point I want to make is just on kind of the food and fuel angle, because I really like to reframe it as that. Certainly speaking from the soybean side, on a volume basis, we always produce for protein. We've always produced for oil as well. As the seed makes both. And I think as we start to look more and more at inflation in any country, but in the U.S., we're talking about really high inflation. We have the luxury of not spending a tremendous share of our income on food in the U.S. Not all countries have that luxury. But if we look at headline inflation, yes, it's in the U.S., but it also applies globally. Certainly food prices are a lot higher. But the huge driver of all this is energy and what's going on. I mean, you look at the CPI that came out yesterday in the U.S. We're at basically 9.4% annualized inflation for food, but energy is up 30%. And if we really talk about food security means availability and distribution. And anything that can happen, I think, to unlock and better catalyze the energy complex, such as emphasis on bio-based solutions, is something that's probably necessary as we think about inflation as a whole, because the distribution matters, and when you hear distribution, that means fuel. So I'm proud to work for an industry that is able to contribute on both of those. Not that there aren't challenges going forward. Arlen, always a great discussion. Always love having you on the program. Always appreciate your insights. Always walk away smarter. So really thank you for joining. Again, I want to encourage all of our viewers to follow Arlen on Twitter at ArlenFF101. Thank you so much for joining.
Thank you.
Jim, back to you.
Wow, what great speakers. Thank you, Mac. Thanks, Arlen. Thanks, Xiaoping. What a great job. I hope you all feel as sort of inspired as I do in terms of having learned something, as Mac just mentioned. Well, we have planting underway here in the United States, as has been mentioned this evening. And as our 2022 crop moves into production, getting ready to supply the world, I just wanted to make three closing points here. You know, globally, demand for soy continues to grow. Consumers around the world depend on it. We heard from Xiaoping tonight about the growing demand that he expects in China. And in whether you're raising aquaculture or another type of livestock, people need soy. And our US soy farmers are reacting to that. They're continuing to plant their crops sustainably, but you see them reacting by planting more acres already planned and maybe even more acres of soy. So they're there for the global consumers. Second point, prices are going to be high. We've heard that. This is, you all see it today. I encourage people to understand how to maximize the value from the US soy you're buying. However you're using it, there's probably a way to make sure you're formulating to get that maximum value for it. Don't over-formulate with soybean meal at a time like this. And work with our team to make sure you're capitalizing on the amino acids, the energy levels, whatever it is, but make sure you're doing that properly so you're maximizing the value. And finally, my third point, export demand will be strong. We heard about that from Arlen. Export capacity will likely be tight. And while we have a very reliable system, there can be lineups developed. So I encourage buyers around the world to get your logistics, get your supply locked in. You may not want to fix the price, but I bet you can work with our great US exporters and make sure you get purchases on the books so you're able to have a supply lined up, because I hate to see people have to wait in long lineups if they need to have supplies. So with that, I want to thank you all for your long-term support, partnership, and business with the US soy industry. We hope that this has been insightful and of value to all of you. I think with these great speakers, I think it would be hard for it not to have been, but I don't want to be overly presumptuous. I want to remind you, we take a survey every time. Please complete the survey. We read those, we try to pay attention to them and make sure we make improvements in the future. We want to know what you want in the future and what you think we don't need to do in the future. Please share that with us. Contact your USEC rep around the world if you have any questions, need information on how to make sure you're maximizing that value. And finally, thanks for your time. And until next time, please stay safe. Please continue to help feed the world. And thanks for your ongoing partnership. Have a great day, great evening, whatever it is, but thank you.